We are seeing a significant uptick in delivery volumes while the derivatives are thinning. The volume in derivatives is thinning. Uh, we see a lot of new people coming into the market, new investors who are coming in, opening accounts over the last 30 days. There has been an incremental surge in the number of new accounts that we're opening right now. A lot of the new money coming in right now is delivery equity only kind of money, which generally has a longer outlook than the trading kind of money. So these people are coming in to take advantage of the 30 to 40% discount they have at hand in really good quality large cap stocks. And they're doing it with a 3 to 4 year outlook in mind, which works well for the market. It augurs well because it brings in quality long term capital into the market. The derivative volumes have thinned. There are issues with allocating money from foreign geographies because of their own inherent issues. We see a lot of uncertainty over market hours being shortened. A lot of participants have called for markets to be shut through the lockdown, both of which we believe to be bad ideas. I think in an ecosystem where we are so closely linked to the rest of the world, peer economies, peer countries with markets like ours have continued to function through this lull and through all of the uncertainty. And they're doing a good job of being able to manage their systems at home. Markets are running smoothly across the world even today. If any kind of precedent has to be taken into notice here, we had the Philippines, which shut down for a couple of days, but when they reopened, they fell all of what they might have fallen through those days at one shot. I don't think this is healthy for the market. Shutting the markets would only prolong a problem, but not solve it in any reasonable manner whatsoever. I think the worst case scenario right now is we don't have any kind of clarity over what is happening with this pandemic, and we are not able to call what exactly is the trajectory, and we do not know if it will take 6 months or 12 months. But I think the hope remains that within 6 months we would have arrived at some kind of a conclusion and would have put this problem behind us. So the worst case scenario will be this pandemic continuing into the next year and going longer than 12 months. The best case scenario is we resolve it after this lockdown, and in 2 or 3 months we see some kind of growth coming back into the picture. Uh, Not too long ago, we were growing at 7 8%, and there were significantly industries which were growing at 9 10 11%, and we were doing quite well. So no reason why we can't go back to that. I think a few inherent fundamentals have to change to support that kind of ecosystem. That would be the best case scenario. The government seems to be focusing on the bottom of end of the pyramid right now. By that I mean the farmers, the day wage laborers, everybody who is actually in need of help right now. I think a large majority of that falls into that bucket. And I think it is good, it is wise outside of how the situation might be for corporates or for the economy at large. I think these are the people who we should all focus on right now and do our own bit to help. Uh, I think in the long term trajectory of how things might pan out with the virus and everything else, I think if we don't focus on this group right now, we'll have more regrets than a bunch of companies not having done well for 6 months or 12 months. RBI stimulus left the market unimpressed. I think markets are forward looking, so they always factor in what is going to happen a little before it actually happens. Though what the RBI did with all the tools they had at hand by waiving off loans for a couple of months, by adding significant liquidity into the market. I think they have done all they could have done, and they've done a great job. But the markets might have factored this ahead of the event because we were all expecting the RBI to do something like this. That being said, there is much more to be done in the future, and we hope the RBI continues to remain proactive along with the government and comes in whenever they are needed and adds that extra boost of liquidity into the ecosystem. Advice to investors, I think uh, you have a fair discount over valuations large companies trade at traditionally. The idea should not be to allocate too much money, definitely do not use leverage, but to build a balanced portfolio where you might have 50% in equities and 25% in debt, and you keep the other 25% in cash. The cash component being to take advantage of any additional downside that we might see is not a bad time to invest. I would recommend people to focus on large cap companies over small and mid cap companies because the larger the company, I think they have more gunpowder to weather the uncertainty at hand. And as long as you do this in a systematic manner without taking leverage, without taking too much of risk and diversifying, putting different buckets into different sectors of our industry, should be par for the course over the long run.